Welcome to Factful Finance. Did you know that roughly 60% of investors fail to diversify their portfolios properly, risking more than they should? Let's dive into how you can avoid that mistake and make smarter, more resilient investment choices. First things first. What exactly is diversification? In simple terms, diversification means spreading your investments across different assets to reduce the overall risk. Imagine if you put all your money into one stock and that stock crashes. You're left with nothing. But if you spread your investments across stocks, bonds, real estate, and maybe even some international assets, the risk is much lower. Some of your investments may drop, but others may rise, balancing things out. Why is it essential for your portfolio? Studies show that a diversified portfolio tends to perform better over the long term than one that is concentrated in a single asset class. In fact, a well-diversified portfolio can help smooth out the highs and lows of the market, making your investment journey more predictable. Now let's get into the practical side. If you're a beginner, think of diversification like a fruit salad. If all your fruits are apples and something happens to apples, your whole salad is ruined. But if you have apples, oranges, bananas, and grapes, even if the apples go bad, your salad still has plenty of flavor. That's the basic principle behind diversification. Take a look at the numbers. A recent study by Vanguard found that investors who diversify their portfolios tend to achieve returns that are on par with the broader market, but with significantly less risk. By balancing stocks with bonds, for example, you can reduce the impact of a market downturn on your savings. Let's consider a real-life example. Meet James. James is a 32-year-old who invests in tech stocks. Over time, he notices his portfolio isn't growing as expected. Why? Because tech stocks are volatile. When the market drops, his portfolio drops significantly. After some research, James decides to add some bonds and international stocks to his portfolio. Over the next 5 years, his portfolio grows steadily with fewer dramatic ups and downs. His diversification strategy made the difference between short-term stress and long-term growth. But diversification doesn't mean you have to pick random assets and hope for the best. It's about strategy. A simple method is the 60-40 rule. 60% of your money in stocks and 40% in bonds. For more advanced investors, you might want to include real estate, commodities, or even alternative investments like private equity. The key takeaway here is that diversification is your financial safety net. It allows you to weather the storms of the market without losing sleep over every market dip. It's about building a resilient portfolio that can grow steadily over time. Before we wrap up, here's a quick reminder. This information is for educational purposes only. Always consult with a professional advisor for personalized guidance tailored to your specific needs. What's the first step you'll take toward diversifying your portfolio? Let us know in the comments. Thanks for watching Factful Finance. If you found this video helpful, make sure to like, subscribe, and click the bell for more financial tips. Until next time, stay smart with your money.